So there is a sizable uptick on Wall Street. Let's take a look at those markets. That market, in fact, has opened up. The Dow Jones Industrial Average trading with gains of close to 1%. The tech-heavy NASDAQ, in fact, is getting quite a bit of a pop right now, up as much as 2.25%. The S&P 500 up by about 1.4%. Those are the headline numbers. But let's look a little deeper. Joining me now to talk about that market and, in fact, everything that is at play right now in the US is Nick Parsons, Head Research and Strategy at ThomasLloyd. Nick, we were speaking last week, if I'm not mistaken, and there was that one very noticeable day of heavy selling where you saw the NASDAQ fall quite dramatically, and you pointed out that at that stage it's possible that because of the kind of retail participation there was on that day, we might be hitting the bottom. Do you think that you can say conclusively right now that we have in fact hit the bottom, and at least for the near term we may not see too much more selling?
Well, good afternoon from London. It's kind of you to remind me of those comments. I think the only thing I would change is to say we may have hit a near-term bottom. I don't think the lows are in yet for the stock market, but I could see the potential for another 2.5% on the upside. And if we're talking in terms of the S&P 500, which is currently at 4,060, that would suggest about another 100 points on the upside from here. However, and there's always a however in stock markets, as you well know, however, the concern has got to be a profit warning that we had from Walmart just an hour or so ago, where they're now actually forecasting that year over year, the earnings per share will decline. Now, that is a real, I think, shock in terms of consumer news. And they're saying that profits are hit by rising prices, falling consumer demand. And that, I think, is something that we've really got to keep our eye on now as we watch the US markets unfold from here.
Okay, what are the triggers that you see in terms of macros, though? Because that is something that everybody is watching for. The jobs picture, the inflation print. A lot of people perhaps saying that perhaps inflation has peaked and that you're going to see readings that are lower than what they have been in the recent past.
Well, in terms of the inflation, to deal with that one first, we did see the decline from 8.5 to 8.3 last Wednesday, and it's still possible that we move a bit lower over the course of the next 2 months because the comparisons with the same month a year earlier are a little easier. So it's possible that we've got a near-term peak in inflation, which might endure for another 2 months. The danger, though, I think, in terms of macro, bearing in mind we've already had one quarter of negative GDP growth, is that over the coming days, we've got new home sales and existing home sales. And one thing that's been very evident over the course of the first 5 months of this year in the US is the rise in bond yields has fed through automatically into mortgage rates, and 20 and 30-year mortgage rates have been a real disincentive, a real dampener on the housing market. And if we see a real set of weak numbers in the coming days, that's existing home sales and new home sales, if those two are on the soft side, then I think investors' thoughts might well be turning to the earnings side of the equation, as well as, of course, to the multiple expansion that we've seen over the last few years. So I think housing and the effect on the consumer might well become a dominant theme in the coming days.
So much, Nick, for joining in. Appreciate the time that you've taken. All right, now another developing